Hello and welcome to Earnings Echo. We put together the most important information about Lyft.
Yeah, glad to be here for this deep dive.
So we're looking at Lyft today because they just posted double-digit growth, record ridership, and basically beat guidance across the board in Q1 2026.
Right, a really solid quarter.
But Wall Street is treating their stock like it is headed straight for zero. Today, we are figuring out why. Did the company actually deliver on its commitments, or is management just, selling us a turnaround story? Let's get right to the hard numbers.
Well, the numbers confirm the execution is actually real. I mean, revenue hit $1.7 billion.
Okay.
And that is a 14% increase year over year. Gross bookings reached $4.9 billion, which marks a 19% jump.
Wait, 19%?
Yeah, exactly. And the bottom line followed suit, posting a net income of $14.2 million, so that equates to a 4-cent earnings per share.
All right, pretty strong. What about looking ahead to Q2?
The guidance remains really strong. Gross bookings are expected between $5.30 and $5.43 billion, with adjusted EBITDA landing between $160 and $180 million.
And see, there is the paradox. When you look at that solid double-digit forward guidance, the stagnant 13.50 stock price makes 0 sense.
It really is a massive disconnect.
Right. I mean, if you looked out your window during those severe Q1 Northeast storms, you would assume rideshare volume just plummeted. So I have to question the quality of that 19% bookings growth. Are they just artificially raising prices on a smaller group of riders, or is there genuine volume here?
Well, the weather was definitely a severe headwind. It cost them an estimated 3 million rides during the quarter.
3 million?
Yeah, 3 million lost rides. However, even with that hit, active riders still surged 17% to a record 28.3 million.
Oh, wow. So it is actual volume growth.
Exactly. It's actual volume driven by two distinct levers. First, high-value premium modes jumped over 35%. And second, their strategic integrations with DoorDash, Chase, and United Airlines are pulling entirely new demographics onto the platform.
So it's increasing how often those specific users ride.
You got it.
Okay, I buy the volume argument, but let's talk about profitability. Because, it is easy to buy growth by just showering drivers with incentives.
Right, the classic rideshare trap.
Exactly. But adjusted EBITDA jumped 25% year over year. What is the actual mechanism driving that margin expansion?
So the mechanism is a structural drop in their cost per ride, and it's specifically tied to recent insurance reforms in California.
Oh, the California insurance changes.
Yeah. By permanently lowering their highest variable expense, which is insurance, they unlocked structural margin expansion. That means they can funnel more money back into marketplace incentives to drive growth without eating into their core profitability.
So the financials definitely hold up. But moving to the earnings call, management leaned heavily into this whole customer-obsessed narrative. Meanwhile, macroeconomic reality is biting hard.
Yeah, fuel costs are spiking.
Right. Are they actually addressing the fact that their drivers are getting crushed at the pump, or are they just glossing over it?
No, they addressed it. They rolled out a dedicated fuel relief program strictly for driver retention.
But won't that hurt margins?
Crucially, no. They structured it so it will not make a dent in Lyft's bottom line this quarter. It remains completely financially immaterial to Q2 earnings.
Oh, smart.
Right, but it acts as a massive lifeline for drivers buying gas every day.
Retaining drivers is great, but the existential threat hanging over this entire call was autonomous vehicles. I mean, Wall Street seems terrified of a robotaxi future. How exactly is Lyft positioning itself against obsolete human drivers?
Well, they're not burning billions trying to build their own self-driving cars. Instead, they're executing a capital-light hybrid infrastructure model.
Like what?
Like this fall, they open an 80,000 square foot FlexDrive Waymo depot in Nashville to manage fleet operations and charging. Over in London, they integrated Baidu vehicles.
So they are partnering up.
Right. They are basically telling AV developers, you bring the autonomous cars, and we will provide the charging depots, the maintenance, and the rider network.
Okay, that explains the valuation gap we are seeing. Let's run a reverse discounted cash flow model to quantify Wall Street's fear. A reverse DCF is essentially financial forensics, right?
Exactly.
Instead of projecting future growth to find a fair stock price, you take today's stagnant 13.50 price and work backward to see what kind of disaster Wall Street is predicting.
Yeah, and at 13.50 a share, Lyft holds an enterprise value of $4.7 billion against a massive $1.12 billion in trailing 12-month free cash flow.
Right, so when you run those metrics, what's the output?
The market implies a negative 13.6% compound annual growth rate for free cash flow over the next 10 years.
Wait, a negative 13.6% growth rate for a decade?
Yes.
The market is pricing in an apocalyptic robotaxi disruption scenario, completely ignoring the 19% bookings growth happening right now.
It is an extreme skepticism premium.
Synthesizing this, you have a hyper-efficient, cash-generating traditional rideshare business violently colliding with an existential AV narrative. The critical echo you need to take away today is deciding whether you trust that cheap 4.2x EV to free cash flow multiple or the market's terminal fears.
Consider this before you decide. If Lyft successfully builds the ultimate fleet management layer for autonomous vehicles, do they even need to own the cars of the future?
That's a great point.
Right. Or are they quietly positioning themselves to be the indispensable operating system for whoever wins the robotaxi race?
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.